Hey, it's Tim and Lisa, and you're listening to the REI Concierge podcast. The REI Concierge helps Americans living abroad find and buy great investment properties in the U.S. From analyzing markets to finding local partners to closing your first deal, we are partnered with you every step of the way. Let's jump into today's episode. Hey everybody, welcome back to another episode of the REI Concierge podcast with Tim and Lisa. We're really excited to have a guest with us today. We have Dave Meyer, Vice President of Data and Analytics at Bigger Pockets, and according to his LinkedIn profile, a skiing, hiking, and sandwich enthusiast. I really want to hear about this part of your life, Dave.
That's right. I mean, wow, I didn't know we were going to go into that part of my life before the real estate part. But yeah, before moving to Amsterdam, which I'm sure we'll get into, I lived in Colorado for 10 years and big mountain guy and also huge sandwich enthusiast. It is my favorite thing to talk about and think about. So it's part of my both my professional persona and my Instagram persona, as I share a lot of real estate data as well as sandwich information to my emerging Instagram account.
Nice. Well, the Netherlands.
But we have to keep going down that hole.
No,
right?
let me just say, like, the Netherlands will serve you well in the sandwich department, not so much in the mountain department.
Yeah, there's no mountains here, but the sandwiches, I've been trying to find sandwiches that are like the big enough quantity to meet my appetite, because I'm a hungry person and they love sandwiches here, but it's like, you know, the bun with like one slice of chicken on it. And that's it. And that's it. Like, you can't get an American sandwich that has like 3,000 calories and will make you full for 12 hours, which is what I want. But you can't find it.
If you get a bun. I mean, the Dutch sandwich is typically that one slice of dark brown bread with some sort of meat on it, and then like some kind of weird mustard sauce and lettuce.
Broodgie.
That's a sandwich. It's one piece of bread.
It's a broodgie, yeah.
Yeah, good.
But it's not the same.
But the
frites.
I
found for my birthday this year, my partner found a proper American club sandwich, like
nice,
overflowing with stuff. It was delicious. So that was, now I've been going back there very regularly. But I think you were saying, Lisa, like the produce is amazing. The food here in general is pretty good.
The food, well, the produce is amazing. No offense to all of my wonderful Dutch friends who I love very dearly, but the Dutch food, not that great. But the frites are amazing. And if you have not been to
the fries.
Friet Atelier, you have got to go to Friet Atelier.
In The Hague.
Or I think there's one in Amsterdam too.
Oh, it's a chain. That's right.
Gourmet.
I'll have to check that out.
Check it out.
Totally amazing.
Yeah.
All right. Eventually we will talk about real estate.
Yeah, I apologize to everyone who is not from the Netherlands or has lived there before or cares less about fries. But this is how we like to start our podcast. This is us. Lisa and I met in the Netherlands. Dave is living in Amsterdam. We got to talk Dutch stuff. So thanks for I guess putting up with us as we talk these things. But let's get into real estate, Dave. Enough with the frites. Enough with the sandwiches. Everyone go follow Dave on Instagram. They'll show you all the one slice Dutch sandwiches you can handle, and just wait for that big American one. So Dave, I mean, I'm a huge fan of Dave. Dave has started BP. I don't know if you started. I'm just going to say you started BP Insights, which is on the Bigger Pockets. Okay, he did. I'm right. It's on the Bigger Pockets platform. It's for pro members, and it's basically just like a number nerds mecca. Like, you can go there and just find analytics on every city in America, every zip code. And I have a jillion questions, as I typically do of our guests, but let's get started with you personally, Dave. Why did you get into real estate? You've been with Bigger Pockets a long time. You were with BP in Denver before you moved to Amsterdam. What brought you onto the real estate train? And then we can get much more into detail about how you pick markets and analytics and stuff like that.
Sure. Yeah. So I got into real estate investing back in 2010. I was a year out of college. And I was going skiing with a friend of mine who was not, let's say, my smartest friend. And he was telling me about this real estate investment that he was doing with his girlfriend at the time. And it just sounded really good. I was like doing the numbers in my head and I was like, man, that actually makes a ton of sense. then I got home and I kept thinking about it. I was like, well, if this guy could do it, I could definitely do it. And so I talked to my roommate at the time and started looking at properties. And I was able to raise some money and interest from friends and family because I had no money at the time. I actually didn't put any money into it. I started just by earning sweat equity and managing the property for free, or in exchange for equity, I should say. And that's how I got started. And I was sort of lucky because at the time, this was still post Great Recession. It was pretty difficult to find a job. And I was looking for ways to make more money. You know, I was waiting tables at the time and I was looking for ways to generate just some sort of long-term plan. And if you guys were investing back then, back in 2010, it was scary to invest because no one knew if the housing market was going to recover. But cash flow was relatively easy to find in comparison to today. So it was relatively easy to find my first deal, and wound up buying a fourplex in Denver, right in Cap Hill, which if I tell you what I bought it for now, people would be very jealous. I guess I'll just say it. I bought it for...
That property did okay for you.
Yeah, $460,000 for a fourplex in Cap Hill. And so that's how I got started, and I really enjoyed it. It was a lot of fun. I screwed up so much stuff because I didn't look at bigger pockets or anything back then. I just was going... just flying by the seat of my pants, but luckily it worked out.
That is awesome.
Wow. So you said you bought that. I have a million questions just from that, but you said you bought it basically by managing the property for equity. Like what, I know, Brandon Turner, one of the big guys at Bigger Pockets always talks, or he wrote the book about getting into real estate with low or no money down. So is that kind of what you did? You just talked to friends and family, gathered the money from them, put it in, and then you said, hey, I'll work this property for my share of equity. Like, can you go into the details just a little bit for folks that are listening that haven't started yet?
Sure. Yeah. I mean, basically, I wound up doing it with 3 partners and myself. And I basically was the property manager and did not just property management, but I would say maintenance as well. So like I was trying to earn equity however I can. And normally a property manager will earn 10% of income, but I really wanted to earn as much as possible. So I was painting and, doing all this work that I was, to be honest, learning how to do on the fly. So I was doing that. And basically in exchange, I was like working off a secondary loan. So one of the other partners basically contributed my share of the down payment. Plus, and so I was paying that back with interest, basically. So I got basically a secondary loan, plus I think it was like 6% loan. And so I was paying one partner back with my sweat equity as we went. And that was the foundation of my first deal because I had $0 to my name at that point and nothing to contribute.
No, that's very cool. And I appreciate you sharing that because we do have clients that are like, okay, listen, I have the knowledge, I know kind of what I'm doing. I have access to capital from other folks, but I have no money myself. And, especially in this market now, it's like, how can I possibly get in? But there's so many creative ways. And I think that's one thing Lisa and I love about it is that, first of all, it's very forgiving. So if you make a big mistake and do everything wrong, like you said, like you're still going to be good, if you hold on to the property long enough. And second, there's just so many ways to get into it. Even if you don't have money, you can trade, your sweat equity like you did, or just kind of like your knowledge of deal finding. There's always ways you can contribute to the deal, even if you don't have that money up front. So I guess let's go into some of the things you did wrong real quick. We don't have to spend a ton of time. We don't have to focus on all the negatives, Dave, but I want to hear a couple things you did wrong. So hopefully people don't have to repeat your mistakes on that quadplex.
And lessons learned.
Yeah.
Right. Like, because that's the biggest part about mistakes, right? Like, what do we learn from them?
I think the biggest mistake just generally is just trying to do too much myself that I didn't know how to do. I shared this story the first time I was on the Bigger Pockets podcast and people still make fun of me about it. But like right when I bought the place, I placed tenants in the biggest units, like the biggest money maker. And there was no railing on the back porch. It was not up to code. And I was like, I could build a staircase. Like, sure. So I would like go over there every day. I didn't even like really own tools at that point. So I was just like going over there and I don't even remember what I spent all these hours doing, but I was there for hours just trying to build literally 2 stairs and a railing. I could not do it. And like, I was just failing every day and it was so embarrassing. And one day I just like pulled up to the property and there's this like beautiful railing there. And I was like, what? How did this happen? This is a miracle. And I like was staring at it and my tenant came outside and she was like, yeah, my dad was here yesterday and he was watching you and you were so pathetic that he just decided to build it for himself. So I was like, please, that's amazing. Thank you. Please tell me how much I owe you for materials, because that is the kind of, thank you for pitying me.
That's
and I guess
amazing.
from then on, I was like, I can learn stuff. And I did learn, watched a lot of YouTube over time, and now can hold my own, but really just learn that you hire professionals and you get what you pay for in the repairs and maintenance and contracting department, and it's worth paying for good quality work.
That's the
Awesome.
best
I love
story.
Yeah, that was the worst one.
So where did you go? Let's keep on your track. So you did that. You're like, okay, this is going to work. And now I'm not even going to ask what it's worth now, but I would assume at least double what you paid for it in 2010. And good for you. But like, what was the next step? And just kind of fast forward through where you are today, I guess, and then we can talk about where you're looking in the future, especially from abroad, because that's right up Lisa and I's alley. So let's go into
Sure.
how your portfolio progressed from that quadplex.
Yeah. So from there, the next thing I did was quite a few years later, and I wound up doing a house hack in a similar neighborhood in Denver, and lived in one unit and rented out the other two units. It was a threeplex. It was 1 block away from my house, the previous place. And I'm a big believer in investing in a way that suits your lifestyle. And I knew that I could manage more properties if I made it convenient for myself. And I did that. So I bought this place that was super close. And then from there, I did that for a few years. And then from there, the next place I bought was actually a primary residence for myself and my partner. And so we moved. And then I now have one other single family in Denver and a short-term rental in the mountains in Colorado. And that's about where I got to before I moved to abroad. And from there, I've been investing mostly in syndications, which I'm happy to talk about. But yeah, I don't have like this massive portfolio. I've been busy working at Bigger Pockets, and that is like I consider that my career, and I'm committed to that and not trying to retire anytime soon. So I'm going with the slow and steady approach.
No, and I think that I appreciate you sharing that, Dave, because I think that's really important. And that's something that Lisa and I talk about a lot with our guests, is that like, and honestly, and we love Bigger Pockets, but sometimes people get turned off by how many doors do you have? How did you get there? Or, how many millions are you bringing? Blah, blah, blah. And it's just for people that are just getting started, it can be overwhelming and just off-putting almost sometimes, like where it's just like you talk to Chad Carson, again, from Bigger Pockets, and you're just like, hey, I have a few properties that cash flow. They're appreciating. I'm taking slow and steady. Like there's no huge rush all the time. And I think that's really important for people just getting started, that like, if you can't jump in at 10, then jump in anyway, get a property and see what happens 3 years later. Like I think getting started is so important, and not being overwhelmed by the door count. And hearing that from someone at Bigger Pockets is super cool. So I appreciate that.
Yeah,
Lisa,
of course. I mean,
yeah.
I think there's just an infinite number of strategies that you can take. And to me, you need to start by identifying what matters to you. And if you are the type of person who wants to retire from their job, whatever that is, then cash flow is super important, and you should focus on getting doors and maximizing that cash flow. But that's just not me. And I think that's a lot of people, even on Bigger Pockets. It's a lot of people who want to work maybe for 20 years instead of 40 years,
Sure.
And that's sort of the approach I take, is like, I want a 20-ish year career, maybe longer. I probably never do nothing, but I like what I do. And so I don't spend every waking hour thinking about what I'm doing for myself. Instead, I get to spend a lot of my time using my skills as a data analyst to help other people learn how to invest in real estate and realize the benefits of this whole industry.
The other thing you said that I really liked, Dave, was knowing that you needed your real estate investment experience to fit your lifestyle. And I think that's so important. And again, kind of reflecting back what's already shared, we look at other people and we think, oh, we got to be like them. And it's like, well, no, we don't. It's like what fits us, what's important to me is different than what's important to you. And that, I love what you said. I mean, yeah, there's a million different ways to go at it, and figuring out what fits your lifestyle is foundational.
Yeah, I just really think that there's a million approaches, and a lot of people get caught up in this like cash flow is king, or financial independence and I need to retire early. And those are totally valid goals, but they are two of many goals that you can have. And if your goal is to build wealth long term, I actually think investing for appreciation is a better way to make money, a total return, than cash flow necessarily. I still look for cash flow in my investing. That's not my primary goal. And so I think, some people are shocked when I say that, but I think that there are a lot of approaches, and just like with anything in life, like figure out what you want and figure out a way to work real estate investing into those goals.
Yeah, no, I think that's super important. And so let's talk about your role a little bit. You bridged a little bit into, you love what you do, and what you do at BP is really the data analytics side and just analyzing markets and putting together all these numbers. So let's nerd out for a little bit, Dave, and let's talk analytics. Because a lot of what we do, when Lisa and I started this company, we spent a lot of front end time trying to pick markets that were going to cash flow. And like you said, cash flow is not everything. But there are markets where you can get you can look at a Seattle or a San Francisco or a DC, where I am now, and find tons of appreciation, but also it's a very high price to entry. So we spent a lot of time trying to figure out those markets that would cash flow for our clients with a little bit of appreciation potential. And I'm sure we did a lot of the same stuff you did, look at population trends and, economic diversity and, military bases, hospital systems, universities, like there's all kinds of things. And people can just get, what I'm trying to see, I'm distracting myself, Dave. This is what I'm trying to avoid, is like people see all these things like, I got to make sure there's a university, and I got to make sure there's a hospital so I can get nurses on my short-term rentals and blah, blah, blah. Like, it's just like, I'm doing, again, Lisa, I'm doing like crazy hand gestures on the video that no one's going to see. It's just all this noise. So like, how do you in particular, and at BP with your insights, how do you sort out that noise and pick what's most important? And then we can maybe get into some specific markets without getting, too far down a rabbit hole there.
Yeah, that's a great question, and something I talk a lot about on Bigger Pockets. And I think, again, it really goes back to what your individual goals are. So if you are looking for cash flow, I find the easiest way to screen markets is using a very simple metric called the rent to price ratio, which is basically, if people are listening, you take the median rent of an apartment, you divide it by of a market, I should say, and then you divide it by the median home price in that market, and you get a ratio, usually somewhere between 0.5% to 1%. And for a long time on Bigger Pockets, we've talked about the 1% rule, which states that anything that has a rent to price ratio of 1% or above is a great deal. Anything below, you should forget. I personally don't agree with that. I think that that's a good rule of thumb, but there's a lot of gray area in there. But I think that's an excellent way to start looking for markets that have cash flow. The higher the rent to price ratio, the higher the cash flow generally. We have done some analysis with BP Insights, and the rent to price ratio correlates to cash flow at about 0.86, which is a really high and strong relationship. So I think when you're looking, whether even that for macro level DMAs, or if you're just looking for submarkets or neighborhoods, this is a really good way to like start narrowing down your markets and interest places that you're looking. Now, if you're looking for appreciation, I think honestly what you said, some of the ideas that you said are really good indicators. Personally, I think population growth and income growth are the two best indicators of future appreciation. It's just simple supply and demand, but the more people who want to live someplace, the higher prices are going to go, given that where we are with construction trends in the US, they are not keeping up with demand. And so if you see a market that's going to have outsized demand going forward, it's very likely prices are going to go up. And then you come to affordability, which is sort of like the big challenge in the United States right now, because housing prices have gone up so much and so much faster than wages and income that we're reaching a point where affordability could really hamper growth in the housing market. And so the way, if you're an investor looking for appreciation, you can mitigate that risk is by finding places. You mentioned a few of those locations like Austin, Seattle, Denver, where wage growth is really strong and is likely to continue. So, I mean, there are a million things you can look at if you really want to get into it. But just at the highest level, those are three metrics that I try to look at on a regular basis when evaluating markets.
That's super helpful. And I think, I think it's helpful to approach it like a funnel, right? So you say, like, let's first look at the price to rent ratio, make sure that makes sense. And like you said, 1% rule, quote unquote, is not really a rule. It's just more of a broad strokes, general rule of thumb, I guess, for lack of a better term. And then wage increases and population growth. And then, once you start hitting, and I guess in your head, you kind of, as an investor, have to set your own metrics, right? So like it's an objective number. The population growth is X% per year. What was the other one? The
income growth.
That's, a set amount per year. And sure, that makes sense. But if you're an investor, you have to kind of set those benchmarks in your head and say, well, I want this number to be that. And then once you hit these benchmarks, you can look further and then, eventually find the neighborhood you're looking at and then eventually whittle down to the actual property. So I think it is a lot to digest as a newer investor, where you're going to find these markets, and I think that's a big part why Lisa and I started this company, is because people are living in the Philippines. They're on tour there for 3 years and they want to invest in America, but like, where do you even start? It's just like and I don't know, it's just like drinking from a fire hose. And I think BP Insights has been super helpful for a lot of people trying to whittle that down, because you guys do all the work, like there's so much analysis in there, and like it's so easily digestible. But you can also get as granular as you want. As like a data nerd, you can really get in there and be like, oh my God, this number is blowing my mind. I have to get in that neighborhood. You know what I mean? And you guys do like county by county and city by city, and it's super cool. So just a plug for BP Insights there.
Thank you.
Yeah, no, it's awesome.
I am curious to know, Dave, when you look at markets, we talk a lot about trends. That's a trendy word, right? A trend. What's the trend in population growth? What's the trend in wage growth? Over what period of time are you looking, and how many years does it need to be before it is technically a trend? Because if it's just 1 year, I'm not going to consider that a trend. So what are your parameters around something trending?
Yeah, that's a great question. And I would personally, when I look at markets right now, I find it quite easy, because we just had a census released, and the full census is released every 10 years. So I think things like looking at population and wage growth, it's quite easy for people who don't have the resources I do, working at a big company that licenses a lot of data, to go on the US Census and take 2010 data and compare it to 2020 data. And you can look over a 10-year period at population growth and population trends, as well as income growth and income trends. Now, I do think that when you're looking at appreciation, that it requires honing in a little more than looking at a 10-year trend, because things have really changed since the pandemic. And
Sure.
There used to be this trade-off between markets. And generally speaking, there were good appreciation markets and there are good cash flows. There are some that are in the middle. I call them hybrid markets, that have a little bit of both. But for years, we've seen this phenomenon where an outlier for good cash flow is also a negative outlier for bad appreciation. So you'll see a lot of cities in the Midwest that meet this criteria, where you'll see excellent cash flow, 12, 15% cash on cash returns. Home prices have been declining for years. Now, since the pandemic, everything has shot up. So the trend has reversed for a lot of these appreciation markets, or these what are traditionally low appreciation markets, let's say in the Midwest, Western New York, where I went to school. You're starting to see these things reverse. So I think you have to look at it on a longer term. You should see what's happening since the pandemic, but also the housing market is starting to come back down to earth. And while I personally believe that we are still poised for strong growth next year, I do think in the markets that have traditionally struggled with appreciation, they're going to come back down to earth a lot faster than markets that traditionally do great at appreciation, like Denver and San Francisco. So I think looking at both is super important because if you look at just the last 2 years, every market looks amazing. But I think we're going to see things return back to a more normal state of affairs probably in the next 12 to 24 months.
So I'm really curious to hear more about the impact of COVID on data analytics and when does a trend come back after such an enormous disruption to everything? Because so many things have been disrupted and different, and these trends have reversed. From your perspective and your expertise, I mean, what are you seeing into the future, and how long before there's some sort of normalization or normal trending again?
Great question, and one of my favorite topics to talk about these days. So
here we go.
When you look at data from 2020 in the housing market, it's pretty much all what you would call anomalous, like something that is just wild, and you can look at it all you want, and I'm happy to talk about that more. But what I would recommend for people to do is look at the relationship between data from right now to 2019. So like when I look at inventory or demand, I'm looking at October 2021 data over October 2019 data. And just for people who are in data analysts, typically you look at year over year data. So you'd say like, are September's housing numbers bigger than last year's housing numbers in September? But in this case, I would recommend, and what I do is look at 2 years back, because last year was just nuts. There's no point in trying to make sense of it. It's more important to see where things are settling, and things are starting to settle. The beginning of 2021, we did still see some really wild swings in the amount of inventory on the market. But things are really starting to shore up, in my opinion. And from my reading of the data, I see a housing market that is actually somewhat stronger than it was pre-pandemic. And I know a lot of people are worried about the highs of the market, and we can talk about that. But if you look at things like the amount of new listings coming on the market, the total number of home sales, buyer demand, the average credit score of someone who is buying a house right now, they are all foundationally sound. And so personally, I believe that the housing market is likely to go up over the next at least over the next year. I'm hesitant to forecast much further into the future, but I do some of this for a living, and I do think that the housing market is likely to keep growing for at least another year.
As we move into 2022, do you plan to skip both 2020 and 2021's data and compare 2022 to 2019?
Just keep skipping these crazy years.
Yeah, I think honestly, at the beginning of 2022, I would, because the beginning of 2021 was still pretty crazy. I think the data looks normal to me starting in like August. So until we get to next August, I'll probably be doing these like hybrid analysis of what's going on. But that's a great question.
Yeah, it makes good sense.
Wow, that's so interesting. And I have so many different directions I want to go, but and I'm just trying to think of what could be the most benefit for our listeners, because I could just go in all kinds of different directions that are interesting to me, because I want to know everything that you're talking about. But let's just say, we get a lot of, one of the biggest questions we always get is now the right time? And that's just such a loaded question. And that could be asked in 1988, that could be asked in 2046, that could be asked right now or in 2019. You never know, is now the right time? And, I had a mentor once that said, yesterday is the best time to buy real estate. Like you've already missed the best deal because that was yesterday. Would you, as a person who is, embedded in these numbers and does this for a living, and professional, market analytics left and right, like if someone comes to Lisa and I today and says, maybe I'll wait until X happens in, March of next year, is that ever a good idea? Or in terms of just not your personal situation, your personal finances, but in terms of the market, like, should people wait? should people, in your opinion, should people do it right now? Should people wait and see if things shake out? I'm doing air quotes again. Or what's the best strategy there?
My advice would be to buy real estate as soon as possible. I wouldn't always give that advice, but right now that is what I am personally trying to do. So I'll just share that. And again, this is just my opinion and my reading
Sure.
of the data, but I do spend a lot of time researching this and think that my opinions are at least supported by evidence. And the reason is, yes, I think we're at the height of a market. We are at a hot market, but I don't personally think it's the height of the market. And I'll give two reasons why I think the market's going to go up. And there's a lot of reasons, but there's two major reasons that I believe the next 10 years are likely really good, are going to be very good for home prices. The first is millennial demand. So millennials are the largest generation right now, and they are reaching peak home buying age. So this huge glut of population is coming to the point where they call family formation, where people are settling down, having kids, wanting to buy home. And now, so this is a huge glut of demand, but we also see that millennials have lower home ownership rates than other generations at this point in their life, but their interest in owning a home is just as high. So they're trying to play catch up, and we have this giant demographic glut. So that means, in my opinion, demand is going to remain strong for at least another 3 or 4 years as we sort through this strong demographic trend. The second is there are just not enough houses in the United States to meet demand. There's a recent estimate that the United States lacks 5 million houses meet 5 million.
Wow.
Yeah.
Last I read was 4, and that was enough.
Right. It was 4. Now it's 5. It just keeps going up, and it's likely to continue. And just for some context, a big part of the crash in 2007 came from overbuilding. People were building speculatively, and there was just too many houses coming on the market. And after the crash in 2007, the pendulum swung way too far in the other direction. A lot of it is because home builders, frankly, went out of business, or people who were in the construction industry went and found other jobs because no one wanted to build a home for like 3 or 4 years following the crash. And it has taken years. We're about at 1996 levels of building right now, even after it's been coming back for almost a decade. And so we're just not keeping pace with the amount of homes that need to be built. And this is simple supply and demand. Demand is really high because of what I was just talking about, and supply is really low. That is the perfect situation for growth. And listen, I'm saying that this is a trend that is going to be, let's say, 5 to 10 years. And I think housing prices are going to be strong over 5 to 10 years. Could there be a time where prices retract 5 or 10% in those years? Yes, like that can definitely happen. But timing that is very difficult. And the reason I personally believe that buying now is so good just comes down to interest rates. Interest rates are at all-time lows and are at a point where I personally don't believe they'll ever go as low as they were, or they might match it, but they'll never go lower. And this is huge. I mean, like if you're investing for the long term, grabbing an interest rate at 3% is an opportunity of a lifetime, honestly. Like they've never been this low. It's never been so affordable to finance a real estate acquisition. And so for me, I know that there might be some volatility 2 or 3 years from now or 4 years from now, but 30 years from now, I know I'm going to be really, really happy that I locked in a 30-year fixed rate mortgage with 3% interest rate. And I'm going to try and do that as much as possible. I am writing a book for Bigger Pockets. I don't know if you guys know Jay Scott. He's like
no, tell us about this.
So
book.
Jay and I are writing a book together, and
Awesome.
We were just talking the other day, and he was saying that right now, like debt is the investment. Like invest in your mortgage. Like that is so valuable, and it's something that if you're investing 5 years from now, like you're going to be jealous that other people locked in a 3% interest rate. Even if prices fluctuate over the next couple of years, that 3% mortgage rate is gold. It's so valuable.
Can you, Dave, I want to stop there for a second. Can you explain that a little bit more? Because I think that's golden. And I think that kind of flies over people's heads sometimes. Like, why is that? So investing in assets that not only hold their value during an inflationary period, but are at, you can lock it in for lower than the rate of inflation is currently, which is, estimated above 4%. if you're getting a 3% interest rate. Can you just, from a macro level for people that are just getting started, just explain in layman's terms why that's so incredibly crucial right now and why it could very well be the opportunity of a lifetime? I think that's very important.
Absolutely. So interest rates probably have one of, if not the biggest impact on housing affordability in the market right now. I did an analysis that looked at someone who is buying a home for $350,000 at a 5% interest rate, which is about where we were approaching pre-pandemic. Mm-hmm. Now, when mortgage rates dropped to 3%, that person could afford, instead of affording a $350,000 home, they could afford a $450,000 home. Their monthly payment would be exactly the same. And yes, you would have to put more down. Like if you're putting 20% down, you'd have to go from 70 grand down to 90 grand down. So that is the factor. But their monthly payment stayed exactly the same. And that's so insane. If you want to know why housing prices have gone up crazy over the last couple of months, of course, supply and demand is a big issue. But think about that. People are paying the same amount and they're buying a house at $100,000 more than they were, and they're paying the same amount. And so it's really this crazy phenomenon. And so locking in this low interest rate means you're going to pay the bank less money over the lifetime of your loan. So you are going to get to keep more profits no matter what happens to housing prices over 10 to 20 to 30 years. You pay less total interest, which is a great thing for anyone who's investing. And I want to come back to what you said, Tim, about inflation, because inflation is at 4 or 5% right now. And that, to me, is an indicator that rents are going to keep growing and home prices are going to keep going up. But if you lock in a 30-year fixed rate mortgage, your biggest expense is fixed. It's not like the mortgage company can come back and be like, oh, inflation's here, we're raising your payments. No, right. You are locked in, but you as an investor have the ability to adjust to the times. Like if rent is going up in your neighborhood and you can raise your rent in a fair way, in a fair market way, 3, 4, 5% to keep pace with inflation, you're just generating more cash flow. And so to me, the ability to lock in these rates, if you're a long-term investor, is the biggest opportunity right now, regardless of whether the market fluctuates a little bit in the next couple of years.
I love it. Thanks, Dave. That was super helpful to just kind of break that down. Because I think that these fundamentals, so people get all, I just kind of wanted to go from like the macro view of how do you pick markets and stuff like that. Because I'm trying to avoid the noise. You know what I mean? I think you're really helping us just kind of pinpoint these are the fundamentals of real estate that are stronger right now than perhaps ever in terms of just the basic numbers, like borrow low, you can rent higher, avoid inflation, an asset that maintains its value, if not appreciates. Like these are the things that people should be thinking about right now, regardless of, I don't know if there's a bubble and, there might be a crash and blah, blah, blah. Well, if you lock in a 3% interest rate, you're good, and especially if you're buying a $200,000 to $250,000 house and maybe not like the $1 million luxury house in Austin, these things don't, Lisa always says these things don't fluctuate as much as these luxury properties. So if you're investing in the 150, 250,000, it might go down to 130 or 230. But as long as you're renting it, you're still getting that income and it's still going to hold its value and it'll come back up eventually. So I think focusing on the fundamentals right now in this time of kind of like worry and speculation is so important. And I think what you just said, I'm excited to read this book that you and Jay are writing. That's awesome. We'll plug it again later when it's released.
Yeah, it's like a year out, but thank you.
Okay, all right. We'll remind people next year, buy the book. But yeah, it's a super exciting time. And I appreciate you highlighting that. And Lisa, you have a question before I go so many different ways. Dave, I'm notorious for this. I just have a jillion questions for you.
No worries,
Lisa,
lay it on me.
Right.
This question is inspired by you, Tim. So I'm curious, as the real estate market has changed a little bit over, and I don't even know how many years to say, but there's more institutional buyers. There's big funds buying single family homes, things like that. How have you seen that trend impact the data? And how does that impact those of us who are individual investors and like the small fries in the real estate investing world?
Should we be scared?
So I just did a whole article about this, and I'll say that there is a lot of media coverage about institutional investors getting into the single family housing market. And I will say that there is not a lot of data that supports that. So I don't know the answer to this question as well as I would like, because there is very little data, at least that I've seen and is reputable enough for me to believe that hedge funds are purchasing in this huge way that is different than it used to be. Now, anecdotally, I believe it. I can see why, based on the reasons that we were just talking about. These are not stupid people. They understand macroeconomics and are probably thinking a lot of the same things that I was just talking about. And also say that other asset classes in the economy right now are not very appealing. It's not very appealing to invest in bonds. You can't, I do invest in crypto, but I recognize that that's riverboat gambling. And I think that the stock market is at all-time high valuation. So you look at hedge funds and in private equity funds who are looking for cash flow and ways to generate returns, real estate is an attractive option. And so I'll wait to find the data, but I do just anecdotally believe it. But I will also say that like the scope of it is just not what people think it is. And so at the last time, in 2018 and 2019 is the last time I could find data, reliable data for this. It showed that about 1% of all single-family homes were bought by institutional investors. That compares to 14% of all single-family homes that are bought by small investors who own 10 or less property. So the scale is totally off, at least the way a lot of media outlets portray it is that, the small investor is still a much bigger player in the US housing market than institutional investors are. There is, I need to look up the exact data, but the largest such company is a company called Invitation Homes. And I think they own around 70,000 or 80,000 single family rentals, which is huge, but it's less than 1% of the total housing market. It's like 0.1% of the total housing market. And I think it's about 1%, don't quote me on this, but I think it's about 1.5% of the total single family rental market. So it's concerning. I think it's a trend that is likely to continue. I don't have a lot of data to back that up, but I don't think it's like the emergency that people think it is on a national scale. Now, I caveat that because if you live in a market where these companies are focusing, it is a big problem. Like there is some data that showed that Invitation Homes bought 90% of the homes in a single zip code near Atlanta sometime during the 2010s. So yeah, if you were in that market and trying to get in that market, that sucks. If you're trying to get into that market, they're buying everything, probably for cash. But if you already own there, it's probably great because they're generating demand and your property value went up like crazy. So I think it's in like a holistic sense, it's not something that I think is like really swaying the market. But when you are picking a market, I think it is important to like look into, are any of these giant companies coming in and buying up homes? A lot of people say like, oh, I would want to avoid that. I'm kind of like, hey, if I can get in that one of those markets, I'll hold on to a few years and they'll probably buy it from me. So I think,
for sure.
It's not necessarily a bad thing for the markets. I think from a competition standpoint, it's tough because they're probably coming in with cash offers. They borrow at a lower rate than you or I ever could. And so they can afford more. So yeah, I think it's like, look at it on a market by market level, but I don't think we're at the point where hedge funds or private equity companies are like really shifting the dynamics of the housing market in any significant way, at least yet.
No, that's really helpful. And it also, I mean, what you say brings me back to that reality that real estate is local. And so we talk about these national trends and whatnot, but I mean, the US is incredibly diverse. And so we've always got to look locally to see what's happening.
Yeah, exactly. I think it's important to understand macro trends in the sense of what you asked earlier about, like, is now a good time to buy? And I think like generally, yes, it is a good time to buy. Does that mean it's a good time to buy everywhere? No, but there are a lot of markets where it's a good time to buy. And so like, I put myself in this position, like, I'll just be honest, like I put some money into syndications recently, but I want a 30-year fixed mortgage at 3.25%. I want that. And so I'm going to start looking for a market. I don't know exactly what I'm going to do, but like, you got to start at the top. I've decided that now is a good time for me in my life to buy. And now I'm going to start looking into some markets based on some of the data we've already talked about. And to me, what institutional investors and their activity is one of many data points I would look at in an individual market, but it's not going to be I wouldn't think it's going to be the deciding factor. I think it's just one of a few things that I'll look at.
That's a perfect segue into this week's edition of Tim.
It's time for Tim's Selfish Questions.
So, yeah, I'm just going to put you on the spot, Dave. Let's go. You are looking to buy for your personal portfolio. I'm looking to buy for my personal portfolio. Some people like to put us on the spot and just say, what's your top 3 markets and why right now where you personally are looking to buy for your portfolio? Because I want to know that, because I want to look there too.
Sure. So I would say I'm focusing on 2 states. I would say Florida and Texas are the 2 ones I'm interested in, with runners up being Georgia and Arizona. But I think that this is a non-data observation, but people tend to love the Sun Belt. When I look at markets, population growth in the Sun Belt is really strong. People also hate taxes generally, and Texas and Florida don't have income tax. And so you're seeing really large increases in companies investing there. The population growth is very strong. And so 3 of the markets I'm looking at are Tampa, Houston, and San Antonio currently.
Okay.
And so those are some of the reasons. And again, the other reasons are because I'm not a purely cash flow investor. So I'm looking for places that offer a 3 to 5% cash on cash return, but very strong appreciation upside over the long term. And I think those 3 markets offer those things.
I love it. Sure. And when you say they offer appreciation upside, what are the analytics you use to that's something that's hard to guess, right? Like Lisa and I always say, you want to bet on appreciation, but you can't bank on it. Like it's not cash flows in the bank. Appreciation is hopeful. There's certainly indicators that show which way it's trending. So what do you use as a analytics guy to forecast that appreciation potential? And you don't have to get super specific, but just kind of, are there indicators is it just past trends, or is it population growth and income growth and stuff like that?
Population and income growth are definitely 2 of the big ones. David Green and I talked about this recently on the Bigger Pockets podcast, but barriers to growth. So if you look at a city like Manhattan, there's not a lot of places to build. And so it's a constraint on supply. I used to live in Denver, and I use an example of Boulder that has pretty strict moratoriums on building and growth, and it has high demand, but you can't build enough homes to meet that demand, and that shoots prices upward. So I look for things like that, job growth investments by either companies or the government in terms of infrastructure, or, for example, I bought a house in Denver. This was my primary residence because the city announced that they were turning this old sort of this whole street that had all sorts of old like industrial properties that were vacant into a park. And I was like, okay, that's cool. And they're also putting in a light rail to the airport right beyond that park. And I was like, this is going to be super desirable. So I just started looking in that area and wound up buying a home and living in it for 4 or 5 years. And so those are the kind of things that it's hard to look at from a data perspective. But I start with the data, narrow down macro level markets, look at sort of areas. And then I think once you sort of pick let's just say, I want to invest in Northeast Houston, then I would start digging into what companies are there, like what companies are moving there, what jobs do people have in this area? Is it in a floodplain in Houston, for example? Like what are the risks or concerns if you're a short-term rental investor? Like what are the regulations? Then I think it's really just like Google time. It's like just start learning everything you can. There's no real good process for it. I think you kind of just got to like be curious and start pulling on the thread for a little while. But that's generally how I'm approaching it.
No, that's all super helpful. And it's fun trying to pick a market. And I guess, so let's talk, and I want to get into syndications, but we might just have to have you back on. We did have a syndicator on, who is, James is currently State Department, James May, Lisa, he was State Department, right?
Yes.
Former Marine, I think, and he does syndications with some active duty folks. So that you said that's something where your money is now. And the thing about syndications for people that don't understand is that they're super passive. It can be great return on your investment, but like once it's in for a while, right? So like I guess you said you and your partner are looking to buy right now to take advantage of these mortgage rates. So that's not something where you can like pull out of these syndications. Like you have to come up with capital from a different source to into these personal assets, right?
That's right.
Yeah, I'm just trying to because syndication is not something where that's what we Lisa and I talk about syndications, and I know you're in one too, Lisa, but that's something it's a longer term commitment. So is that something you're looking to get it more into now too, Dave, or is that kind of a different strategy for a more long-term passive approach?
Yeah, I generally am trying to diversify my real estate holdings in multiple ways. So different markets and different strategies. So before I moved to Europe, I was all in Colorado and mostly single family rental or just sort of residential, I guess, because I have a couple of multifamily, but and one short-term rental. But I am just curious, like I don't have the energy right now, to be honest, to like do a BRRRR, like to really oversee a rehab from abroad. People do it. It's definitely possible. I'm just not going to do that. And syndications are attractive to me because I think you can, find someone who is an experienced renovator and put some money there. And it gives you a nice diversification of return timeline. Like I have cash flowing properties. I get money now. That's great. I have properties I'm looking for. And like I said, I'm really investing for 30 years from now. So that's a long return, before I see the full benefit of that. And syndication is usually a 5 to 8 year return. And so I'm just kind of trying to stagger these things so that I have income and investments sort of coming to fruition at different points.
I love that viewpoint. I like that. Just kind of a different timeline of returns, much less the diversification of risk. It's also diversification of like return timeline. That's kind of cool way to look at it.
Dave, as we work towards wrapping this conversation up, we are super grateful for your time and for you sharing your expertise with us. And I'm curious, a lot of our clients, a lot of our listeners are on the newer side of their journey in real estate investing. And I'm just curious what words of wisdom you have for those who are more towards the beginning of their investment journey.
I would say that real estate is relatively forgiving. And I think people see real estate as very risky. And there's good reason. You do have to put up a lot of capital for real estate. It's not like in the stock market where you can start with $1,000. Like you have to bring some money to the table, and that is frightening. But from a data perspective, I like to remind people that there are very few times in American history that the housing market has actually declined for an extended period of time. And, I'm a millennial. And so I think I am, generally scarred, as a lot of people of my generation are, by the Great Recession. And like that was the greatest decline in housing prices in American history by a long shot, significantly more than other times. And even the people who invested at the height of the market earned a pretty strong return if they held on to right now. And so I think it's important to remember that if you have liquidity and cash flow and you can weather a storm, you are pretty much always going to make money in real estate. It's really about being able in control and being able to choose when you sell. You don't want to get into a position where you're forced to sell. You need to have enough liquidity to be able to determine when you want to sell. And then the risk is really pretty low. There's all sorts of data I could share about that, but generally I just like to remind people that it is a relatively safe investment if you're going to pay attention to it and, manage your property well.
No, I appreciate that. And it's interesting just to notice my own experience in listening to you and knowing you study the data for a living, and to hear you say that. I mean, I know it, I say it all the time. And it also has just a a calming effect on me, even though I'm totally bought in. I'm like, yes, you're not have to convince me on anything. And also knowing that you have the data and study the data and all of the data tracks what you just said, that, yeah, there's like an extra calming impact of that. So thank you very much for that.
Of course. One thing I like to remind people is that there's 4 ways you make money in rental property investing. You get cash flow, appreciation, amortization, or also known as like loan pay down, and tax advantages. And so the third one, amortization, where you're just basically paying off your loan. Even if you never make $1 in cash flow, and even if your house doesn't appreciate, you generate a 5 to 6% compound annual growth rate just by paying off your loan. So that is enough to outpace inflation right now, even though inflation's at the highest rate it's been in like 2 decades, or it shortly was higher in the Great Recession. But my point being that like you're probably going to make a 5 to 6% return on a bad deal. So like that is not bad considering that the S&P 500 returns about 7 to 8% on average. So just something to think about.
That's awesome.
Such good stuff to think about.
So
and Dave, we're going to link to your bio and everything on Bigger Pockets and analytics, and encourage people to go pro on Bigger Pockets, even though we don't usually sell stuff here. But I think it's worth whatever it is, $30 a month for that, just access to BP Insights. But more importantly, my last question for you is, what's your favorite sandwich?
Okay, so this changes, the moving target, but
yeah,
my heart, I'm from New York originally. My heart is in a chicken cutlet sandwich, like chicken cutlet with bacon, mayo, and honey mustard is like it's what I ate like growing up. And so I do love that. But honestly, I'm going to be biased. I don't think they make good chicken cutlet sandwiches outside the East Coast. Like you can get them in New York and Boston, but I've never had a good one outside New York. But it's been a while since I've been home. So that's what I've been craving recently.
It sounds delicious. I love that. I just went to this is a complete non sequitur, but I just found a Roy Rogers. I don't know if you remember Roy Rogers, but I haven't seen one in years.
I didn't know they still exist.
Yeah, they're there. Like I'm a realtor too, Dave, and I was doing a showing in this part of the Maryland where I haven't been in a long time, and I saw it, and I got the Gold Rush chicken sandwich. I don't know if you remember that from my childhood. It was terrible. It was terrible. Like I don't want to like disparage Roy's, much less the Gold Rush, because it's like such a cherished memory for me. But it had been sitting there for at least 2 weeks. Like it was so cold and like just a dry little nugget. But I'm gonna go back again like during lunchtime and try to get one again. So I've just lost all our listeners, and I apologize again as I usually do. But I appreciate you playing along, Dave. It's been awesome to have you, and I have so much more to ask you. So we'll have to hopefully have you back in the new year sometime if you'd be so gracious.
Of course, yeah, I'd love to come back
for everyone. Fantastic, thanks, Lisa. You do a better job of wrapping us up. I'm going to throw it back to you.
Dave, thank you very much for joining us. We're really appreciative of everything you shared. And thank you, listeners, for listening, for sharing this, and for taking time to leave us a review. Until next time.
Happy real estate adventures.